Today, we are pulling back the curtain on a massive, multi-billion-dollar magic trick hidden deep inside Alphabet's latest earnings report. Honestly, forget the boring balance sheets for a minute, because we're looking at a high-stakes AI chess game that Wall Street might literally be completely misreading. So let's dive right in and ask the critical question here. Is Google still this unstoppable, money-printing cash machine we all know and love? Or are they sprinting blindfolded straight into a massive debt trap? Because as you'll see, the headlines screaming about an earnings beat and the actual math underneath the hood are telling two very, very different stories. Let's start with Section 1, the 1-cent magic trick. Okay, so Alphabet reported a staggering $37.7 billion in what they call other income. But get this, a massive $36.9 billion of that wasn't actual cash from selling search ads or cloud subscriptions. No, it was just an unrealized, paper-only gain from their equity stake in the AI startup Anthropic. It's exactly like checking Zillow and seeing your house value shot up. You feel incredibly rich on paper, but you don't actually have that cash in your wallet yet, right? And here is the absolute kicker. Without that specific, massive accounting markup, Alphabet would have actually missed Wall Street earnings estimates by exactly 1 single penny per share. Just think about the gravity of that for a second. The entire difference between a headline-grabbing, victorious earnings beat and a disappointing miss came down purely to paper profits on an AI startup. Which brings us to Section 2, the billion-dollar AI loop. So how did that paper profit actually happen so fast? Well, welcome to the ultimate I pay you, you buy from me ecosystem. It works like this. Google commits to investing up to $40 billion into Anthropic. Suddenly, Anthropic's valuation skyrockets to $380 billion. Then Anthropic immediately turns around and commits to spending $200 billion buying Google Cloud services and chips over the next 5 years. So Google pumps in the cash, books a massive paper profit, and gets your own money right back in sales. Brilliant, right? Well, it is a beautifully engineered ecosystem until it isn't. You see, this perfect loop is actually incredibly fragile. If Anthropic's next funding round stalls out, or worse, if they hit a down round where valuations drop, that massive paper gain completely vanishes from Google's books overnight. Paper wealth can burn up incredibly fast. That leads us right into Section 3, the AI debt trap. Because moving beyond those paper profits, we have to face a much harsher reality. We're literally watching a fundamental shift in this company's DNA. We are moving away from the old Google, the unstoppable cash-generating fortress, and morphing into the new Google, which looks a whole lot more like a debt-funded gambler rolling massive dice in this AI arms race. Just look at the receipt for this gamble. Management recently bumped their fiscal year 2026 capital expenditure guidance to a jaw-dropping $180 to $190 billion. Building out the physical infrastructure, the massive data centers, the chips to power the future of AI isn't just expensive, it is incinerating capital at an absolutely unprecedented rate. And that astronomical spending, it's already bleeding them dry, right where it hurts the most. Free cash flow, which is essentially the actual usable cash you have left over in your checking account after paying the mortgage and all the bills, plummeted 47% year over year, down to just $10.12 billion. The giant cash cushion that investors have literally relied on for over a decade is rapidly deflating. So to fund this relentless race while their cash flow drops, what do? They have to hit the banks. You can see right here, their long-term debt skyrocketed from $46.5 billion to $77.5 billion in just a few short months. That is the very definition of a massive structural shift toward living on credit. Now, let's look at the broader picture in Section 4, macro risks and oil. Taking on this mountain of debt is risky enough on its own, but the macro environment, totally outside of Google's control, is turning aggressively hostile. With Middle East tensions rising, Brent crude oil is trading above $100 a barrel, and analysts are warning it could hit $150 if supply routes choke. Now, why does oil matter for a tech giant? Because expensive oil means sticky inflation, and sticky inflation forces the Federal Reserve to keep interest rates high. So Google is pivoting into massive, debt-funded growth at the exact moment borrowing money has practically never been more expensive. Which brings us to Section 5, the bear market valuation. So with all this going on, what is the company actually worth underneath it all? Wall Street bears run the math using what's called a discounted cash flow model. It's basically just a formula to calculate how much cold hard cash the business will generate over its lifetime. Even if we're super generous and give them 21% revenue growth, we still have to subtract that massive capex spending drain and the harsh reality that AI chips become obsolete and depreciate incredibly fast. When you plug all of that into the model, the math points in a really scary direction. The model pegs Alphabet's true intrinsic value at just $172.85 per share. Guys, that represents a terrifying 56% downside from recent trading levels. It shows exactly how heavily the market bears are punishing this new, debt-heavy structural shift. But we always want to be fair here. Section 6, bullish counterarguments. To give you the full 360-degree impartial view of this explainer, we absolutely have to respect the bulls, because Google's core business is still an absolute titan. I mean, look at this. Cloud just posted its strongest quarter ever with a massive 63% year-over-year surge, backed up by a $460 billion backlog. And search revenue? It's still growing at a really healthy 19%. So despite all the noise, AI definitely hasn't killed their legendary ad machine just yet. Plus, there is the ultimate Wall Street wildcard waiting in the wings. If Anthropic pulls off a massive initial public offering down the road, those paper profits we talked about earlier, they turn into billions in hard cash, potentially vindicating Google's entire wild spending spree in one single brilliant move. So, as we wrap up this explainer, I'm going to leave you with this thought to chew on. Is Google a sleeping giant executing a brilliantly calculated long-term AI checkmate? Or are we witnessing a fragile, debt-heavy great reset built on a house of cards? Let that sink in. Thanks so much for diving into the numbers with me today, and keep your eyes peeled out there.